Think about the last raise you got. Maybe it was 3%, maybe 5. You felt it. A little lighter, a little more room to breathe. And then, quietly, something happened. Groceries cost a little more. Your rent went up. The same coffee you've been buying for years now costs what lunch used to cost. And somehow, at the end of the month, you're exactly where you were before. You earned more, you spent more, you have the same. That is not a coincidence, that is the money illusion. Let's start with something simple. The number in your bank account right now. Whatever it is, say it's 10,000. That number feels solid, stable, real. It's a fact. It's sitting there. It doesn't move. It doesn't disappear. 10,000. But here's the question almost nobody asks. 10,000 what exactly? Not dollars or euros or pounds as abstract units. 10,000 worth of what? What can that number actually buy you today compared to what it could buy 5 years ago or 10? This is the difference between nominal value and real value. Nominal is the number. Real is the purchasing power, what that number actually gets you in the world. And these two things drift apart, slowly, constantly, almost invisibly. The number stays the same. The reality behind it shifts. That's the illusion. Here's why it's so hard to feel. Imagine you earned 50,000 this year. Next year you earn 52,000. You got a raise. Your number went up. You might feel slightly better off. But if prices across the economy rose by 5% in that same period, your real income actually fell. You're earning more on paper. You're buying less in practice. But the number went up, and so the brain registers it as a win. This is not a quirk. This is a known cognitive bias. Psychologists call it money illusion, the tendency of humans to think in terms of nominal value rather than real value. We anchor to the number. The number is concrete, the number is memorable, the purchasing power behind it is abstract, diffuse, hard to visualize. So we celebrate the raise, we feel the salary increase, we don't feel the 5% erosion that canceled most of it out. Your landlord increased rent by 8%. The supermarket raised prices on things you buy every week. The bill for the same broadband package is higher than it was 2 years ago. Each of these individually feels like that company being greedy. The prices went up. But zoom out, all of it went up, everything at once, gradually, in the same direction. That's not company behavior. That's the monetary environment those companies operate in. Now let's go one level deeper, because here's where most people stop and where the real understanding starts. Inflation is not a glitch. It's not a failure of policy. In most modern economies, a steady, moderate level of inflation is the stated goal. Central banks around the world don't aim for zero. They aim for around 2% per year. That number is deliberate. It is chosen. Why? Think about what happens in a world with no inflation, or worse, falling prices. If prices are falling, what's the rational thing to do? Wait. Don't spend today what you can spend next month for less. Don't invest today what might be cheaper to deploy next year. Economies depend on money moving, spending, lending, building, hiring. In a deflationary spiral, money stops moving, and economies that stop moving contract painfully. So moderate inflation keeps things in motion. It creates a mild but persistent pressure. Money sitting still loses value, so use it, deploy it, invest it, spend it. That pressure is a feature, not a bug. There's another piece. Governments carry debt, enormous amounts of it. Inflation, over time, quietly reduces the real weight of that debt. A government that borrowed $1 trillion 20 years ago is paying that back in dollars that are worth less than they were then. Inflation is, in this sense, a slow-motion debt relief mechanism built into the monetary system. This is not a conspiracy. These are the incentive structures of the system. Inflation serves real economic purposes. The question is not whether it exists, the question is who it helps and who it costs. Here's the turning point. Inflation does not affect everyone equally, and this is perhaps the most important thing you can take from this video. Think about three people. The first person has $50,000 in a savings account, earning low interest. The second person borrowed heavily to buy a home 10 years ago. The third person owns a portfolio of assets, property, businesses, shares. In an inflationary environment, what happens? The cash saver watches their $50,000 quietly shrink in real terms. The number stays the same. The purchasing power behind it falls by 2, 3, 4% per year. They did everything right. They saved. They were disciplined. And the environment they saved in worked against them. The borrower is in a different position. Their debt is fixed in nominal terms. The loan they took out doesn't adjust for inflation, but their income, their asset value, their home price, those drift upward with prices. In real terms, their debt load shrinks over time. Inflation paid down part of their debt for them. The asset owner, their wealth is not stored in cash. It's stored in things. A piece of property, a business, a portfolio. These things participate in the inflationary environment. Their prices rise, their values adjust. They don't perfectly track inflation, nothing does, but they behave fundamentally differently from cash in a low-interest account. This is what economists mean when they say inflation is a wealth transfer mechanism. It's not a crude one-to-one transfer. It's structural, systemic, and it quietly, persistently redistributes purchasing power from cash holders toward borrowers and asset owners. This is why the phrase exists. Inflation is a silent tax. It doesn't appear on a tax return. There's no line item, no bill, but it charges you nonetheless, and the rate it charges you depends almost entirely on where your wealth is stored. The reason most people never fully reckon with this is psychological. Gradual change is almost impossible to perceive in real time. This is not a uniquely financial observation. It's just how human perception works. We notice sudden changes. We adapt to gradual ones. Your grocery bill didn't double overnight. It crept up, item by item, week by week, over years. At any given point, the change was small enough to dismiss. By the time the cumulative shift becomes visible, it already feels normal. The new price is the reference point. Adaptation happened without you choosing it. Psychologists call part of this anchoring. We anchor to the number we first learned, the price we first paid, the salary we started with. When reality drifts from that anchor, we feel it. But as the anchor moves with us, the perception of drift fades. You're always comparing to recent memory, not to where you actually started. And so the price of something 10 years ago feels unreal. Not wrong, just distant, almost like it happened in a different economy. Which, in some ways, it did. Now, here's where this shifts from observation to usefulness. Understanding the money illusion is not an invitation to panic. It's an invitation to think more precisely. Because once you see the structure clearly, you can make better decisions inside it. Cash is a tool. It is extraordinarily useful, liquid, flexible, immediately deployable. You need it for daily life. You need a buffer of it for stability. But as a long-term store of value, as the place where you park wealth indefinitely, it has a structural weakness. It's designed to move, not to sit. And in an environment built to keep money moving, assets that sit in cash face constant, quiet erosion. The distinction that matters here is between liquidity and wealth. Liquidity is access, the ability to pay for things now. Wealth is ownership, claims on things that hold or produce value over time. A healthy financial life needs both, but confusing them leads to decisions that look right on the surface and quietly underperform over years. Things that tend to hold or build value, skills, ownership stakes, productive assets, businesses, behave differently from cash. Not because they're magical, but because their value is tied to real things, real productivity, real demand. They participate in the economy differently than a number sitting in an account. None of this is a recommendation to buy any specific thing. It's a shift in how to think about the question. The question is not just, how much do I have? The question is, what is that amount of purchasing power actually doing? Is it at work, or is it sitting still while the world moves around it? And there's one more mental shift worth making. Earning more isn't enough on its own. The relevant question is whether your income grows faster than your costs. If everything around you is rising by 4% and your income is rising by 2%, the number on your payslip is going up and your standard of living is slowly going down. The gap between your earnings growth and inflation is the real measure, not the nominal one. Here's where we land. Money is one of the most powerful tools humanity has invented. It is remarkably efficient. It lets you exchange your labor today for food, shelter, time, experience, things you couldn't make yourself. It is a kind of stored potential. But it is not neutral. It is not static. It exists inside a system built around growth, debt, movement, and the slow, constant erosion of cash in favor of those willing to deploy it. None of this means the system is rigged against you. It means the system has rules, incentive structures, design parameters. And like any system, the people who understand how it works are better positioned than the people who never look at it closely. The money in your wallet is losing value right now. Not dramatically, not catastrophically, slowly, by design. The question is never whether that's happening. The question is whether you're thinking about it, or whether you're anchored to the number and missing the reality behind it. The number stayed the same. The world moved. That's the money illusion.